So as investors, we are just bombarded with continuous news on stock market performance. And we think it can be really helpful just to take a step back and ask the question, are the common investment indexes that are on the financial news media every single day a proper point of reference for you, or for me? Or should it be something different? So that's what we're going to spend time on today. My name is Matt Mockelstead. I'm a lead advisor at Foster Group, and this is our financial perspectives video for the week ending June 18th. Before we get to that topic, we're going to spend just a little bit of time on some key news items from just the last 2 weeks. And the first is the June 10th inflation report. And the largest piece of news here is that the consumer price index increased by 5% for the year ended May 2021. Now, that's actually the largest increase or annual increase we've seen over the last 13 years. It is important to remember that the starting point, so May 2020, it was a low point. So there were some actually price decreases a year ago because of the global pandemic and the shutdown. But as you can see here, all items, that 5% number is on the left. And then this provides a look underneath the hood at all the different categories. And you can see that the range of price increases over the last year really varies, with energy, gasoline, and used cars and trucks having the largest increase. Now, inflation was also part of the discussion at the Federal Reserve meeting that concluded on Wednesday, June 16th. And Federal Reserve Chairman Jerome Powell made another comment that he views inflation to be largely transitory for the reasons we just talked about. We hit a low point last year, and now we're just simply bouncing back off of that low point. There's no change to the federal funds rate or the bond buying program. And probably the largest piece of news from the meeting was that the median forecast on the dot plot now suggests that there might be 2 rate hikes in 2023. And this is overall just earlier and higher than what was previously expected based on the March meeting. So moving on just to investment markets, this is a look at just the last 2 weeks, the S&P 500 in the purple, the US small cap market in the light blue, which is the Russell 2000, international markets in the green, and then the bond market in the yellowish green. And you can see that overall, most markets treaded water or marginally positive for most of the 2 weeks. And then towards the end of last week, markets dropped a little bit as they were digesting some of the news from that Federal Reserve meeting and the news on interest rates. Taking a step back now and looking at investment markets year to date, you can see that stock market indexes towards the top are still all positive. And then the bond market towards the bottom, still marginally negative on the back of rising interest rates this year. So moving on to our question, what is a proper point of reference? And to start this part of the conversation, I thought I'd first just share a quick story. So this is a picture of me running a local 5K, actually a couple years ago now, because it was canceled last year. And I'm giving a couple of high fives there to 2 of my boys. And if you've ever ran a 5K before, you know that at the end of the race, there is usually a monitor that shows your results. And when I look at that monitor, I am in no way close to being first on the scoreboard. However, I don't really care. What I really cared, or what I was most interested in, was seeing how I did compared to other males aged 30 to 40, which is my age group. And I wasn't necessarily looking at how well I did compared to the winner or the high school track team that participated. And I probably would have been frustrated if I did, because as I said earlier, I wasn't even close. And when we think about investing, we think that investors can be helped, or it can be helpful for them to think similarly about their investment portfolio. What are their benchmarks, and is it a good or proper point of reference for them? When we look at financial news media, what you mostly see are indexes like this. So this is just a snapshot of what you see on CNBC or the Wall Street Journal. We have the Dow Jones Industrial Average, the S&P 500, the NASDAQ Composite, and then the Russell 2000. And it's helpful to think through, well, what do each of these mean, or what makes up each of these indexes? And that's what I'm going to show you here. This is a look at these common investment indexes and some of the characteristics. And what you'll notice is that for the most part, these are pretty much 100% US companies. So no international stocks, but mostly all US. The number of stocks really ranges between these indexes, with the most noticeable one being the Dow Jones Industrial Average. There's only 30 stocks in that index. The market cap, um, the first three all have very large average market cap um, numbers. And the standout here is the Russell 2000. That index itself only measures the US small cap market. So very small companies. It doesn't include the big companies like Apple or Amazon. So that average market cap is much lower. Now, what you see here is um, the primary indexes. And what is not here is any international representation. And for most investors, you're going to hold some sort of international stocks. And when I put up the international or a global stock market index, the MSCI All Country World Index, we think is a really good representation of a market cap weighted global stock market. You'll see that the United States only makes up 58% of the global stock market. So there's a lot outside of the US that might make up a globally diversified portfolio. Now, in addition to this, it's pretty interesting to look at the different sector weights in each of these indexes. And there's a lot on this page. So I highlighted a few key points here. The largest differences you see will be in financial services. You'll notice, just compare the Dow Jones to the NASDAQ, a pretty big difference. You'll see the same thing looking at industrials. And then technology. Technology in particular, the NASDAQ composite is roughly 40% in technology stocks, compared to just over 17 for the Dow and just under 13% for the Russell 2000. So that's a pretty high overview of these indexes. And going back to our question, so are these a proper point of reference for you, for your portfolio, or for your goals? And it really depends on what you're trying to measure. If you just wanted just a broad representation or a general idea of how the US stock market is doing, then those first three are pretty reasonable to look at: the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. Just knowing that there's some differences in the actual sector exposures. So if, for example, if the NASDAQ is doing much better, it might be because technology is doing really well. And that's a big part of that index. The Russell 2000 would maybe be a better point of reference for a small subset of your portfolio, just a small cap piece or a part of your portfolio. But for most investors who hold a globally diversified portfolio, they are pretty incomplete by themselves. And overall, when we work with clients, a lot of times what can be really helpful and what is most often used is an objective driven or goals based benchmark, because every investor has their own definition of what success looks like. Just like I did in that 5K, my goal was not to be the fastest runner. It was to simply do my best and be reasonable in my age group. For an individual in a family, they might simply just want to generate a good retirement income to live the life that they want to live. For a nonprofit, it might be a certain spending goal or a spending rate that is really specific to their organization. So it really depends on who you are as an investor and what you actually define as your goal. And to end us off, I wanted to just point us back to our May 24th video. Kent Kramer, he talks to Daniel Wallach from Vanguard, and they have a really good discussion on some different types of goals and comparing your success to others, which goes right into what we talked about today. So I'll leave you with that. Go back and watch that video. Thanks so much for watching. If you have any comments, always feel free to let us know or want to learn more about our firm. You can check out the link here. And of course, we're always open to talking with you if you'd like. Thanks so much for watching.